Good morning, everyone. My name's Karen Munsey, BOQ's Group Executive for Corporate Affairs and Investor Relations, and welcome to our interim results announcement for 2015. Welcome to everyone who's here in Sydney, as well as those on the phones and watching via webcast. John will speak, followed by Anthony, and then I'll be back to facilitate the Q&A. So I'll hand over to you, John.
Thanks very much, Karen. Good morning, everyone, and thanks for joining us at our first half 2015 results, my first official results announcement in the CEO chair. We'll follow the usual format today. I'll cover off the highlights, Anthony will talk to the financials, and then I'll be back with our priorities and to sum up. Turning to slide 3, we're pleased to announce a solid set of results which represents another record half profit for BOQ. Most pleasing for me has been a return to growth. A year ago, we had no overall balance sheet growth in the first half. In contrast, for the first half of 2015, we've added $1.3 billion, including around $270 million from BOQ Business, over $400 million from the mortgage broker channel, and around $470 million from BOQ Specialist. While the market for both business and home lending remains incredibly competitive, we are growing our book without compromising asset quality or cutting price to the bone. Anthony will talk in more detail about loan growth, but I would like to call out the performance of BOQ Specialist in its full 6-month contribution to the business. A highlight was the delivery of $350 million in on-balance sheet mortgages for the half, on track to exceed our target for the full financial year. In terms of our ongoing transformation, this has been another solid half of execution. We've commenced the transition to our new IT services contract with HP. Work on our lending program is progressing, while our cultural transformation continues with the majority of our Brisbane-based staff moving into our new premises. In summary, as I said at the full year, what you see today is a bank that has come a long way in recent years. Strong foundations are now in place, and we're well into building a bank that is lower risk, lower volatility, and set for sustainable growth. Slide 4. You'll see we've delivered improvement across most of our key performance metrics. Top-line growth has been delivered through a combination of asset growth and further improvements in NIM. Costs were impacted by a number of one-offs that we've called out previously, including property relocation costs and the CRM system impairment, as well as the inclusion of BOQ Specialist. Pleasing, however, if you strip out the underlying noise, expense growth would have been 3% annualised from the last half. On slide 5, we've called out performance for both return on equity and return on tangible equity. We flagged marginal dilution for FY15 return on equity at the time of the Specialist acquisition, with expectations to again see ROE accretion in FY16. We've delivered another strong ROTE performance, up 60 basis points on the previous corresponding period to 13.8%. Shareholders have continued to be rewarded with a further 2 cent per share increase in the interim dividend to 36 cents per share, while we've delivered total shareholder return of 15% for the 6 months to February, compared with 12% for the broader financials index. Turning to slide 6, you'll see our 4 strategic pillars listed across the top. Customer in charge, which is about enabling customers to deal with us when they want and how they want. Growing the right way or balancing risk and return. There's always a better way, which means greater operational efficiency. And lastly, being loved like no other, which means having the right people, capability and culture to ensure success. In terms of delivering against that strategy, an undoubted highlight has been that return towards system asset growth that I mentioned earlier. Today, for the first time, we're providing more granularity on the shape of our mortgage book, including details of our average LVR, which sit at 65%, and investor lending flows, which are well within the 10% target set by the regulator. Anthony will talk to this in more detail. It's also pleasing to see business banking expanding its customer base with growth at 1.2 times system, and that's despite increasing competition. In the property development space, for example, we've been very selective in new financing given some of the trends we're seeing. This includes development covenants such as pre-sale levels being traded away, and believe it or not, we've also seen a return to mezzanine finance by some of our competitors. I'd like to call out BOQ Finance, which is a key player in the asset finance space. In a flat market, BOQF has grown assets this half by diversifying its origination sources. Several new intermediary partner programs have come on board this half, including a large technology firm, who are returning after 3 years given our superior offering and customer service. Turning to NIM, we've seen a 20 basis point increase over the last year to 1.97%. Even with an 11 basis points contribution from BOQ specialists, this is a strong performance, and we continue to see the benefits of credit rating upgrades to A-, while actively managing our funding profile to offset the headwinds of tighter lending spreads. Balance sheet and capital strength is an absolute non-negotiable, and this result sees further improvement in key metrics, with impaired and bad and doubtful debts both continuing to fall. We believe at these levels we may have reached the low point in the cycle. Finally, our transformation program continues, particularly to unclog the arteries of the bank through digitisation. That work will ultimately remove paper from our branches, allowing branch-based staff to spend more time with customers and less time on administration. It will also help us expand further into the important broker channel, where we now have nearly 2,000 brokers accredited in WA, New South Wales, Victoria and Queensland. Turning to slide 7, and I want to provide an update on the performance of BOQ specialists for the first full half reporting period under BOQ ownership. The slide shows performance across the key metrics we outlined at the date of acquisition. Firstly, the business is comfortably on track to deliver the maintainable earnings guidance of $38 million for the full year. Overall, you can see that our assessment of the potential for this business was pretty close to the mark, delivering in line or ahead of our expectations. Commercial lending growth of 11% in the first half of 2015 is broadly in line with the 13% the business had achieved over recent periods. The business traditionally has a stronger second half due to the seasonal lending spike in June, so we're very comfortable with this momentum. Commercial asset spreads have performed slightly ahead of our expectations, with bad and doubtful debt expense continues to track in the mid-20 basis point range. This is still well below the level you'd expect to see for a traditional commercial lending portfolio and reflects the attractive credit characteristics of this segment of the market. As I mentioned earlier, the growth in mortgage origination and the momentum in mortgages on balance sheet is particularly pleasing. Overall, we're very pleased with the progress of this business, which has had no loss of key staff and continued growth in customer numbers. Finally, on slide 8, you'll see our 2012 management targets. These targets were set at a time when we were in a very different place, and we needed to demonstrate where we believe we could take the bank. We're in a very different position today, which means these targets are just no longer relevant, particularly as they exclude any contribution from Virgin Money and BOQ specialists. That's why you won't be seeing these targets again. This is their last outing to the market, and we're currently reviewing the metrics we will use to measure our progress against strategy. I'll now hand over to Anthony to cover the financials in detail. Thanks, Anthony.
Thanks, John, and good morning to everyone. It's a pleasure to be here today to take you through the details of what is another strong result, albeit impacted by a couple of one-off expenses which have reduced the overall headline numbers. 6 months ago, we talked about getting the business on a sustainable growth trajectory, and I think you'll see from these results that we're now starting to deliver that outcome. If you turn to slide 10, we provided a view of the underlying business performance, splitting out the performance of BOQ Specialist from the remaining businesses. John's already outlined the performance metrics of the BOQ Specialist result. However, I did want to point out that the $19 million result for the half did absorb the impact of the new on-balance sheet mortgage strategy with reduced upfront commission income from third parties. The impact of this, after netting off the additional investment interest income that we would have earned over the period, was $1 million after tax. This strategy, whilst being an immediate impact in the short term to earnings, will drive enhanced earnings growth in future periods. It also demonstrates why we believe we're comfortably on track to deliver maintainable earnings guidance of $38 million for the full year. Whilst this is a higher margin business, it does operate a higher cost to income ratio, which was 53% for the half year period. This has resulted in a rebasing of the group's underlying cost to income ratio at the 45% level, consistent with the impact that we did outline in previous presentations. Now turning to the performance of BOQ, excluding the specialist business, as you can see in the table, the standout figures are net interest income, which was up 7% on the same period of last year, and loan impairments expense, which was down 30%. Although operating expenses were up 13%, the 2015 first half was obviously higher as a result of the CRM impairment and the higher property transition costs that we did flag of $6 million. I can confirm that that is the end of those property costs. And that is in line. I think the guidance we gave previously was uncertain as to which half period it would end up in, and it's all cleared in this half. Excluding these, operating expenses were up 5% on a prior corresponding period basis. Slide 11 shows the key drivers of the performance when the one-off costs are excluded. Cash earnings of $148 million was a 6% increase on the prior corresponding period, but if you remove the impact of those one-offs, you will see the growth would have been 14%. This was a combination of both underlying profit growth from net interest margin expansion and the improvement in the impairment expense line. When you then add in the BOQ Specialist result, that contributed a further 14% to earnings growth. In aggregate, a 27% increase in cash earnings, excluding those one-off costs. The 14% contribution to growth from BOQ Specialist compares very well to the 10% of share capital that we issued to fund the acquisition, and does demonstrate that we are on track to deliver in advance of the EPS guidance accretion that we gave to the market at that transaction. We think that's a pretty strong performance in what remains a competitive market, and does demonstrate our ability to grow earnings whilst continuing significant work program to transform the business. I'd now like to touch on the reconciliation of cash to statutory profit on slide 12. As you can see, the main item of note is the integration and transaction costs associated with BOQ Specialist. At the time of the acquisition, we assumed there'd be integration and transaction costs of $23 million after tax, along with $6 million relating to balance sheet transition. To date, we've incurred $16 million within those buckets, with the remaining integration and transaction costs expected to be incurred in the second half of the year, in line with our expectations that we'd outlined in April at the date of the acquisition. The BOQ Specialist Banking Licence handback project is well advanced, and we would expect to have this work completed in the middle of the year. Turning to slide 13, and I'm now back at a combined group view. It's great to see that our loan portfolio is returning to growth from the initiatives that we've put in place in previous periods. I'm talking specifically here about the broker business, our business banking expansion, as well as the BOQ Specialist business. As John has flagged, we've been disciplined in our approach to growing the business, and have the benefit of being able to extend our reach into new channels that we've opened up for our customers, rather than having to compete in our established markets. We've also seen continued improvement in the diversification of our portfolio, with Queensland now representing 52% of the portfolio, down from 54% at the end of 2014. Slide 14 provides a good demonstration of the growth momentum that is building across all portfolios. As I just mentioned, housing growth is being driven predominantly by our mortgage broker channel, as well as the BOQ specialist mortgages that we've been able to originate on our balance sheet. It's fair to say that our branch network is finding growth challenging, as higher levels of runoff have again offset new business that they're originating. The owner-manager network has remained virtually flat over the last 3.5 years, as we have undertaken some reconfiguration of that channel. The corporate mortgage book growth has improved with a positive contribution to growth in the half, a reversal of approximately 150 million from the negative drag in the prior corresponding period. We remain confident that as we free up our branches to be able to focus more on productive activities as part of our digitisation program, their ability to grow assets will return, but this will be a story that we expect to emerge in FY16. Commercial loan growth has remained strong, with BOQ's business bank continuing to expand capability and BOQ specialists growing, as we've already discussed. Our leasing business, BOQ Finance, is also a good news story, as it's been able to grow grow in a market that is going backwards. So to sum up, what has been a significant area of focus for us, the charts on this page do set out a positive story for our growth momentum. Commercial lending growth is at levels we are very comfortable with. On housing, the levers of growth available to us, that John will sum up later, give us solid prospects to maintain a sustainable growth trajectory. Moving to slide 15 now, and the liabilities specifically, it's evident that we continue to strengthen the balance sheet, creating a sustainable funding profile that is able to support balance sheet growth and deliver internal capital generation, as evidenced by the recent long-term credit rating upgrade by Fitch to A-. During the period, we continued to focus on building out our long-term wholesale funding profile and increasing our senior unsecured debt issuance. The increase in long-term wholesale funding has strengthened the profile and allowed reducing reliance on short-term wholesale funding and less sticky, price-sensitive retail deposits. Our funding mix and deposit strategy has been a significant contributor to the maintenance of the net interest margin over the half, as shown on slide 16. A 10 basis point contribution from funding and deposit initiatives was able to offset headwinds we continue to face in the form of front book asset pricing spread reductions and the earnings rate on capital and low cost deposits in a low interest rate environment. We've seen a 9 basis point contribution from BOQ Specialist in the half, which is in addition to the 2 basis points of benefit we received in the second half of 2014 for a combined contribution of 11 basis points. This is slightly above the 9 to 10 basis points guidance we provided at our last results announcement. Given there are a lot of moving parts in the margin equation, it is difficult to provide guidance on the outlook ahead. The current competitive dynamics are driving further expected asset spread reduction, but at present, deposit repricing does seem to be sheltering this impact. If we now move on to the non-interest income slide on page 17, the headwinds that we have flagged in prior periods are still being felt, and continue to put pressure on this income line. The St Andrews business contribution to other income has reduced by $4 million for the half. This has resulted from a reduction in underwriting margins of 24%, due mostly to higher life insurance claims following a period during the past 2 years in which claims have arguably been below longer-term trends. We do expect this is a temporary elevation and the experience should improve in the second half. The St Andrews business has been successful in retaining a number of key distribution partners in the period, including Bankwest and IMB, and entering into new agreements with partners including CUA. We did flag headwinds for the earnings of this business at our 2014 results, and again in an announcement to the market on the signing of the Bankwest agreement in December. Changes in the portfolio mix, including an increase in regular premium policies and a shift to direct-to-customer channels, are evident in the sales results, but had little impact on the underlying result in the current period. This impact is expected to emerge over the life of the policies, which is approximately 3 years. The Virgin Money business has provided a positive contribution of $1 million to other income for the half, as the credit card business in particular starts to achieve scale. Turning now to expenses on slide 18, and as we've already discussed, there was a significant impact from the CRM impairment and the property transition costs. If you exclude those items and the BOQ specialist business, our underlying cost growth for the second half of 2004, from the second half of 2014 was 3% on an annualised basis. As previously flagged, the integration of BOQ Specialist into the group will rebase the cost-to-income ratio with the group on target to achieve a cost-to-income ratio of 45% in the second half of 2015. We continue to see an increase in the carrying value of our intangible assets as we invest in digitising and transforming the business. As the chart shows, the balance of intangible assets increased by $8 million in the half. Moving to slide 19, loan impairment expense has continued to improve, reflecting the improved credit management practices, favourable realisations in the commercial portfolio and benefits from the continued low rate environment. The first half loan impairment expense of $36 million, or 18 basis points of gross loans and advances, was a $4 million or 4 basis point improvement on the second half of 2014. All of these figures now include BOQ Specialist. The only portfolio that has seen an increase is the BOQ Finance portfolio, which has increased 3 basis points in the half to 69 basis points. The vast majority of this portfolio is performing extremely well, as you would expect in a low interest rate environment. Stresses evident in the mining services and transport sectors have been the largest contributors to the loss experience, and no surprises, this is largely WA and Queensland based. Our exposure to the mining sector remains small, and this portfolio is still within the through-the-cycle range we'd expect from this business of 70 to 75 basis points. We remain comfortable with the risk profile of the portfolio. Looking at impaired assets on slide 20, there was a reduction of $34 million or 12% over the half through favourable realisations in the retail and commercial portfolios. Only one exposure greater than $5 million transitioned into impaired status in the first half and remains our only greater than $5 million exposure. When we look at arrears levels, and I'm now on slide 21, retail arrears in the 30 plus and 90 day past due buckets both increased over the half. This increase is consistent with first half seasonal trends and not outside of our expectations. Looking at commercial arrears, they've been relatively stable over the half after a substantial improvement in the prior half. BOQ Finance arrears have increased in the last quarter, most notably in the 30 plus delinquency bucket. An element of this does reflect some exposures from the asset finance and leasing portfolio acquired through the BOQ Specialist acquisition, for which we took significant provisioning coverage after undertaking our due diligence pre-acquisition. As with my earlier comment on impairment expense in this portfolio, arrears performance has also been overweight in the mining services and transport sectors. Positively, the two largest accounts that have dropped into the 30 plus arrears buckets over the half, and that did occur in February, together totalling $2 million, have already been cured in March. We've included some detail on our housing portfolio on slide 22 in response to the increased focus on these portfolio dynamics. We continue to see improvement in the quality of our housing portfolio with our more rigorous risk management practices, and although we've historically attracted a higher proportion of investor loans relative to our industry averages, with a portfolio weighting of 44%, our new lending flows are much closer to the market averages at around 40%. And we are growing our investor book well below the 10% level that APRA is monitoring. Likewise, the LVR buckets on our portfolio and for new business are generally in the middle of the pack in the industry, so we don't foresee any greater impact on our portfolio growth aspirations relative to the broader industry should any macroprudential tools be used by regulators to slow housing growth. Turning to slide 23 and capital generation, Common Equity Tier 1 has increased 19 basis points to 8.82% in the half. Underlying cash earnings in the half was more than enough to support loan growth of $1.3 billion and a 2-cent increase in the interim dividend. The growth in risk-weighted assets in the half was skewed towards higher risk-weighted commercial lending, and the growth across the whole portfolio was back-ended. As such, we don't get the full earnings from the business in this period. We also have the headwind of no growth in the prior period that would normally be present to provide revenue growth momentum. The business does have the capacity to support a substantial lift in mortgage growth to beyond system levels. There is also quite a bit of noise in the other bucket, shown on the chart, with some of the one-offs that have contributed 22 basis points to Common Equity Tier 1 over the half. The largest of these relate to reduced deductions for deferred tax assets and some benefits from increased reserves that are eligible for inclusion in regulatory capital. Moving now to slide 24, we've included some detail on the amount of work that's been going on in the background to improve our risk management practices. So although we don't have a formal advanced accreditation program, many of the initiatives underway across the group are progressing us further along the path to becoming a well-run bank, with most of the building blocks for advanced accreditation in place. Given the ongoing uncertainty on capital and the benefits that will be available under advanced accreditation, we're focused on building a better bank which provides a number of benefits in itself. Given the regulator is reviewing the path to advanced accreditation, including the potential for decoupling of some of the elements, we are holding off on making any significant investments that are aimed solely at advanced accreditation until the pathway becomes more definitive. In the meantime, much of the work we are doing is getting us closer to that goal in any case. With that, I'll hand back to John to talk through the outlook and wrap up.
Thanks very much, Anthony. I'll now talk to how we're seeing the business environment and the current state of play on bank capital levels before turning to our priorities and wrapping up. Turning to slide 26 and the business environment. I'm not the first CEO to say that the economy is currently running at a pace that is well below long-run trend. But I'm naturally an optimist, and there are some positive factors supporting the economy. Population growth is likely to remain relatively strong, particularly when measured against Australia's developed country peers. Many parts of the construction industry are performing well, and exports are strong in the non-mining sector. The lower Australian dollar should also help spur activity. But all that said, a sustained improvement in the economy will require a pickup in consumer and business confidence. And the single biggest factor that will support an increase in confidence is greater certainty of government policy at both the state and federal levels. Turning to state performance, conditions remain mixed. New South Wales is doing relatively well, while the declining mining investment is impacting the WA economy. In our home state of Queensland, conditions continue to vary significantly from region to region. Mining-dependent areas are starting to find the going tough, while much-needed rain and higher prices are providing support to the parts of the rural sector. The benefits of a lower dollar are finally starting to flow through to the tourism-dependent areas. Our chief economist was in Cairns talking to business last week, and he tells me that after a few barren years, the green shoots of recovery are becoming increasingly obvious, with bookings for a number of operators on the rise. On slide 27, I'd like to turn to the very topical issue of capital. We've continued to work closely with our regional bank peers in relation to the FSI and also around the proposed Basel changes. It would be a very brave bank CEO who would make any prediction about where all these deliberations will end, but it's clear that global bank capital levels are heading higher, particularly for advanced accredited banks. And a subject dear to our heart, it is also clear that the very large differential that exists between advanced and standardised banks for mortgage risk weights has largely been discredited. While we accept that there needs to be an incentive in the system for advanced banks, the reality is that the mortgage risk weight gap in Australia today needs to be narrow. We welcome the comments by APRA Chairman Wayne Byers in Canberra last week, recognising that while the international landscape needs to settle over the next few months, it is unnecessary to wait for every I to be dotted and every T to be crossed before responding to the FSI's recommendations. We would point to examples where other countries have moved outside Basel timelines and processes to implement change. Fast action is needed to help level the playing field, which is currently skewed heavily in favour of the major banks in this country. We will also continue to advocate for a decoupling of the three components of accreditation: market, credit and operational risk, which may well result in a shorter implementation path. Given the many moving parts and uncertainty about the process and benefits of accreditation, the timing of any application by BOQ is something that we will continue to assess. Turning to slide 28. This slide shows the journey we've been on in recent years to reinvigorate the bank. There is no doubt we've come a long way since 2012. I'm particularly proud of the risk culture that is being embedded and the strides we've made to improve asset quality. For example, through risk appetite statements, triggers and limits in place right across our portfolios. Our brand reinvigoration has been important in helping to drive cultural transformation internally. The latest NPS figures show an 8-point increase in 6 months to a score of 24, growth that is well ahead of the broader industry trends. We certainly have a lot on our plates as we contemplate what we call laying the foundations, but there's no doubt that the business is now set for growth. Turning to slide 29, I'd like to outline our current organisational priorities and touch on the outlook. We'll continue to expand our new channels of distribution, including brokers, where we expect to have 2,500 accredited brokers in place by the end of the current financial year. Work is underway on Virgin Money branded mortgage, which we expect to launch in around 12 months through broker and direct channels. We are leveraging group capability to bring Virgin mortgages to market, particularly in IT and operations, while delivery of the lending program is also an important component. The Virgin Money brand remains a significant opportunity for us, given the strength of the brand and its appeal to a very different target market to BOQ's traditional base. And in time, we see potential for a broader suite of products, including deposits. In business banking, we don't pretend to be all things to all people and remain focused on growing in specific sectors of the market. BOQ Specialist is a good example of that niche focus, and that the business should maintain its growth momentum given the seasonal skew to the second half. While growth is a key priority, it won't come at the expense of margin or quality. While lending competition remains intense, rest assured that we will continue to resist the temptation to grow assets through cutting prices or moving higher up the risk curve. We talk internally about growing the right way, whether that's through increasing a PAYG exposure via the broker channel or the balanced scorecard approach we've introduced to the branch network. We've now started rolling out the first of the OMB commission agreements based on this scorecard, with 4 signed and another 10 in the final stages. This rollout will take a couple of years, and as much as possible, we'll accelerate through an opt-in process. Branches have had visibility of the new scorecards for well over a year, and in general, there is a desire to sign up and move forward. In addition to growth and growing the right way, our third priority is our ongoing program transformation, where key initiatives this half include the lending program, implementation of our new IT services contract with Hewlett-Packard, and the integration of the BOQ Specialist banking licence. The lending program is on track to start piloting in pre-production environment from late next month. We'll be conducting a test and learn approach across the lending life cycle for a few months to ensure each step of the process meets the needs of the business. We're still targeting a rollout for originations from late this calendar year, with some phased delivery around the back-end enablement into 2016. Benefits should start to flow through from the second half of FY16. We've started rolling into our new IT contract from 1 January. The cost benefits of this new agreement will be phased in over the course of this calendar year, as previously discussed, will help shelter us from growth in our amortisation profile. In summary, the first half of 2015 has been good for BOQ, with another record half-year profit and strong shareholder returns. In terms of business conditions, while we see little prospect of a turnaround in either business or consumer confidence, we remain comfortable of our ability to manage these conditions. In summary, I remain confident that the future for BOQ looks bright, and we remain focused on providing superior service to our customers and the wider community, building a sustainable financial performance and delivering consistent growth in returns to shareholders. Thank you, and I'll now hand back to Karen for Q&A.
Thanks very much, John. We'll go to questions here in Sydney first. Could I ask that you wait for a microphone, and then we will go to questions from the phone. We might start with you, James.
It's James Ellis from Credit Suisse. Just two questions. Firstly, the non-interest income, 84 million for the half. Just wondering whether you thought that it could hold there, given your comments around insurance and what has been a fairly considerable contribution from trading income. And then secondly, in terms of the branch numbers, which have been declining steadily. Previously that had been more concentrated in New South Wales, but in this result had been sort of spread more nationally. Just sort of if you could give us some explanation around what was happening there and whether the network there is right-sized. So non-interest income and branch numbers.
Thanks, James. Look, I'll talk to the branch numbers, and Anthony can talk to the non-interest income line. Look, if you remember back to what I said at at our full year results presentation, the way we at BOQ think about branch numbers and customers is you've got to take the lens that you've got to actually have a distribution network that actually allows customers to choose how and when they want to deal with the bank. And that's our first premise. And if you think about where we've been for the last few years, we've remained outside of one of the fastest growing channels of distribution, and that's brokers. And this time last year, 4% of all of our settlements came through brokers. We're now at 14%, and if you look at the industry, it's closer to 50%. In terms of the branch number reduction, I think we're down 10 for this half. A number of those were consolidations, where owner-managers actually consolidated. A number of them were owner-managers that have been in the business to 7 to 12 years who decided to retire. And also we actually opened up another Icon branch as well. So we don't have a predetermined number of branches that we want to move or reduce to, but what we are doing is looking at all of our points of distribution, and it's through that lens of how consumers want to deal with us. That includes the digital channel.
On the other income line, as you've called out, there are a number of moving parts to this. The St Andrews underwriting result, with the claims experience that it has had, we wouldn't expect that to occur in the second half. I mean, you can never predict these things accurately, but we do see it as a blip. Around the trading income, it's probably a little higher than we would expect to see it ongoing. In the transition to the new liquidity requirements, we were conservative in the amount of liquid assets that we raised in advance. When we finally did our calculations as to what we were required, we didn't need as much of that. So as that, we were fortunate during that period that those bonds had largely appreciated. As we sold them down, we got an extra bit of income out of that. Those two items, we think, largely probably offset themselves, but we have called out the continued pressure on this line and reasonably low prospects for growth for some time, and we'd expect those to continue. And we're also flagging that the St Andrews transition of its business to regular premium policies is going to be a drain on that line going forward.
Okay, John, we might go to you.
John Mott from UBS. A question on the dividend. We've seen the divvy go up by 2 cents per share now for 5 or 6 halves, and in the last half it pushed the payout ratio up to 79%. To pay for it, you've had to leave the DRP discount on, and obviously issuing new shares to pay for this. This can obviously become a problem when you're paying out and obviously having to constantly issue shares to do it. So is it time that you actually consider pausing the dividend to let the earnings catch up, or are you going to continue to increase the dividend at 2 cents per share and the payout ratio keep rising?
Look, I might start with that, John. Look, we carefully consider as a management team what we recommend to the board in terms of our dividend payment, and obviously the board takes careful consideration of that, and we always have one eye on to what our capital generation levels are, and I'll have Anthony talk to a little bit about that. We're not giving any guidance at all about what future dividend growth will be, but the way I think about this is that we need to build a sustainable business that can go right through the cycle so that we can continue to reward our shareholders, and we're comfortable with the dividend that we've declared today.
Great. Thanks, John. Look, a couple of things I'd probably cover. Around capital and capital levels, and I know there's been a lot of speculation about some institutions moving higher into the nines area. I think we would, our view on that is that those institutions are the advanced banks, and that movement to those ratios we would suggest is in advance of impending changes to mortgage risk weights in that space. So as the denominator then gets adjusted for them, we would expect some readjustment back down as to where those levels sit. We believe that the target range that we've talked about for some time of 8.5 to 8.6 is appropriate for the organisation. It's set to maintain our ratings position comfortably in the A- band with each of the agencies. And we take a view that the capital is better in the hands of our shareholders than it would be lazy on our balance sheet. Clearly, we've had a growth in dividends that's been in the 13 to 14% rate, and you would be heroic to suggest that that's a rate of growth in dividends that would continue for an extended period of time. We continue to monitor this. At the moment, where we see the changes in the growth profile of our business going forward, we think the optionality of that dividend reinvestment plan is sensible for us today until we really see the benefits of the different levers we have to pull for how the business performs in the growth aspirations we have going forward.
Yep. Okay, do you want to...
Morning, Mike Wiblin from Macquarie here. Maybe if we just take a bit of a step back and look at the strategy a little bit. If I look at slide 10, underlying growth looks pretty weak, sort of down 2%, half on half if I take out CRM and specialists, or maybe flat if I take out property. But then you sort of talk about, on page 24, investing significantly for growth, which I think is fine. But to James's point, you're then sort of closing branches as well. So, I mean, how do I reconcile those different elements? I mean, what John, are you going to do at Bank of Queensland? You know, what do you want to do? Do you want to growth? Do you want to grow, or do you want to actually manage for returns? Or you know, what are your plans?
Well, thanks very much for that. Look, our focus is to make sure that we've got a business that can actually withstand the various cycles that go through, that the Australian economy goes through. And we are planning for growth. I'm very happy with where we sit at the moment. You know, when you include BOQ Specialist, we're at about 0.9 times system. We've had good growth through our business bank, and we remain really focused on that. We're actually seeing good growth through the broker channel. And I think, you know, the announcement that we've made today about bringing Virgin to market over the next 12 months will again allow us to continue on our growth trajectory. So we're very, very focused on that, but we want to do it in the right way. And I've been in banking for 20 years, and I've been through a couple of cycles, and it's very, very easy to rush out and stick assets on the balance sheet and then pay for it dearly in 2 to 3 years, inevitably when the cycle turns down. And we've got one eye on growth, but actually the other eye very firmly on growing the right way.
I might just add, and just to reinforce, that our strategy hasn't been about trying to compete harder in our established markets. It's actually been about extending into channels where we're opening ourselves up to customers to deal with us in different ways. We think that's a preferred strategy. Yes, it takes longer to execute that strategy than an alternative, but we actually think that's the right value for the long term. To the point of your question around earnings momentum, clearly we had a very significant step up in the underlying business in the last half, and the step up in this business, which you've called out as a contraction, is less pronounced. There is a bit of noise, particularly when you look at the previous half. It had the free funding benefit of the lazy capital in the net interest income line in that half. If you strip that out, if you also recognise that the net interest income half on half because of day count for us on 3 days is about $7 million. On a strip out the noise basis, our view is that the business did grow underlying profit by a small amount in the order of 2% annualised. And it did have strong growth in earnings when you factor in the improvement in the impairment expense, closer to 8 to 9%.
Just a quick follow-up question, just on broker. Do you think you can grow aggressively in the broker channel without it having an impact on margin? I mean, every man his dog is in there now, and obviously competing very aggressively. So, is that are you comfortable that that's not going to have an impact on your margin?
Yeah, look, we're very careful about how we look at the broker channel. It is a very competitive market out there, and obviously, we get to see some different things out there, and different banks change their commission rates, they change their trails, they try to attract different rates. So we've been very consistent in what we do. The go-to market product that we have is our ClearPath Home Loan. It has great acceptance right throughout the brokers that we are using. Again, I come back to the fact that we're only, settlements 12 months ago, last half of 4%. We're now at 14%. And a lot of our competitors are actually a lot higher than that. But we're reasonably happy with where we are at the moment. We're very happy with the commissions and the trail that we're currently paying. And to your point about margin, we fight for every basis point. It's not only just the front book, it's what we can do in the back book. And I think that over the last few halves we've proven that we can effectively manage our liability book as well to help us with our front book acquisition.
Okay, we're going to take one more question from the floor and then we're going to go to the phones.
It's Andrew Triggs from Deutsche Bank. Just a question on asset quality, if I could. And just the mixed signals that the impaired or the new impaired flow and the arrears rates are showing. I note your comments, Anthony, around some one-offs and some seasonal impacts in the arrears rates. And could I also just in that context check your comments, John, that you were seeing sort of bottom of the cycle levels now in terms of bad debt to gross loans? Just your feeling on the medium term for asset quality.
Yeah, you want to start?
Yeah. Look, I think you've got to be, one exposure greater than $5 million in a portfolio of our size, and it is the only impaired asset greater than $5 million, is not a bad outcome, to be honest. So I think that's probably put down to the law of small numbers. And yes, there has been a seasonal uptick, and it's a little bit more pronounced than it was 12 months ago. At this stage, it's too early to call out whether that's a significant concern. There's nothing that we're seeing in the underlying portfolio that would suggest that is. And a lot of it will come down to the confidence, as John said, in the broader economy as we move forward to that. So I want to comment about the cycle.
Yeah, look, I think my comments around the cycle is really it's based on the industry, and we all know that we've seen a fairly benign cycle for the last few halves. And obviously, with a lower interest rate environment, maybe the prospect of even further lower interest rates, that will shelter that. But there's a lot of forces out there in the economy at the moment, and if you look at the economy is going through a major transition, say from the heavy investment into mining. Some of those projects are now coming onto stream. We see a little bit of that. We also see a little bit of it as well, particularly in our BOQ finance book, where people are delaying their investments or that inertia is increasing on a lot of CapEx equipment. So it's more a comment about where the industry is at the moment, and we're probably getting close to the bottom of that cycle.
Okay, we're going to go to the phones now and then we'll come back to the floor.
First phone question comes from Craig Williams from Citigroup. Please go ahead.
Good morning, everyone. Now that you're back towards system growth in the retail market, what on the lending side, what will be the impact of asset spread on this new business versus the roll-off of the existing book? And where's the sort of greatest source of front book competition that you're seeing? And the second sort of part, deposit balance growth has now slowed during the period. Will funding mix and cost reductions actually be able to offset asset spread contraction in future periods as we've seen in the last half?
Well, thanks, Craig. Thanks for the 8-part question. I'll start with the competition around what we're seeing in the competitive market at the moment. There's no doubt that competition is red hot out there in the market at the moment, and probably the one thing that we do see is that most banks have a published SVR, and ours are probably on the higher side. But most of the front book acquisition amongst the banks are actually a go-to product. So our go-to product is ClearPath. It is competitively priced. It's not at the bottom of the market. It is probably towards the middle of the pack. But one of the features that we're actually seeing a lot in the market at the moment is significant under-the-counter discounting in particular. And we've also seen, probably in the last month and a half, increased competition amongst a couple of the very large competitors in the broker market as well. And look, it ebbs and flows week by week, depending on whether people want to increase or decrease in what they're doing. And it also is very targeted at times to say lower LVRs, higher loan sizes. So we've been competing in this market for a long period of time, and we'll continue to do so, but not cutting our price to the bare bone, and we don't want to do that.
Just on your question on the deposit growth, we have taken the opportunity over this half, now that we've had all 3 credit rating agencies upgrade us to the A- category, to really build our senior unsecured credit curve. So we've now got a complete curve across the full 5-year spectrum. That has increased our duration and the resilience in the book, and it's given us a greater access to that part of the wholesale funding market. And we've been using that, if you like, to pay down our reliance or reduce our reliance upon the higher cost hot money retail. So that's largely been a neutral cost, but we think built us better resilience in the balance sheet. So from an absolute deposit growth perspective, you're probably seeing a negative outflow that's disguising an underlying growth in what we call relationship-based deposits from the business. So we're reasonably comfortable with how we're positioned in that regard.
I just want to add to that as well. Being a smaller, more nimble bank, both Anthony and I get the opportunity, every week to sit down and look at what's going on both sides of the balance sheet, so that we can actually move quickly. And it's, we're very focused on fighting for every basis point that we can get.
And probably to that directional question around margins going forward and whether the deposit spreads can shelter the asset spread repricing. We, as I mentioned in the presentation, we have seen, I think, a reasonably disciplined approach to the repricing of the liability side that has been managing margins on an industry basis with some stability. You're correct that we'd need that to continue if asset spreads and front book space is going to continue at where it is at the moment. And where I think if you go back 12, 18 months ago, we had a lot more confidence that we had levers to pull, given our reliance upon the higher cost component was much more pronounced. We don't have the same capacity in those levers today, and I'd suggest we're probably more in line with the rest of the market, absent John's comments about thinking that the ability for us to see what's directly happening in the balance sheet gives us, we think, a bit of an advantage.
Thank you for the comprehensive 8-part response.
Next question is from Richard Wiles from Morgan Stanley. Please go ahead.
Good morning, gentlemen. I just wanted to ask about your thinking on the guidance. As I understand it, at your previous update, you said consensus was at 362, less than 7 million for the CRM write-down, brings you back to 355. Following today's result, that's implying that you've got to deliver about 5% growth in the second half, excluding the one-offs. And the way I look at it, you've got to get much better trends in the second half to meet that guidance than you've just achieved in the first half. John, given your comments in response to Craig's question around margin, given Anthony's comments on deposit pricing versus asset competition, what confidence can we have that you're going to meet that guidance for the second half? Are you relying on better momentum from the specialist business? Are you relying on better revenue in the core business, or are you thinking loan losses can go lower again?
I might start that one. On the chart that we had on slide 11, if you strip out the one-off noise, we delivered 178 million of earnings in this half. As I did flag before, we do have a day count difference, 181 versus 184 days. Doesn't sound like a lot, but the net interest income line is the biggest line on our profit and loss. It's about a $7 million kick. If you just roll that forward, that gives you a nice... You're well into the low 180s to get to the 188 number that we need to achieve. So again, we would expect increased momentum in BOQ Specialist over and above that, and just general growth momentum in our business.
Yeah, I'll add to that as well. But all of our lines of business have had a very good first half in terms of performance. And if you look at, we've talked a lot about BOQ Specialists. We talked a lot about the seasonality that they actually have in the second half. One of our unsung heroes is BOQ Finance, and it's actually growing ahead of where market is. And we've certainly got momentum back in the retail bank, and particularly through the broker channel. And again, just draw you back to our to the attention that we're relatively small in that particular part of the market, and there is still considerable scope for us to grow, and we're very mindful of our costs as well.
And John, if we look at the core business, to get BOQ Specialist for a moment, which does seem to be going reasonably well, you're still growing below system in mortgages. It's quite possible that margins are down in the second half. We've got the resumption of the rate cut cycle. We've got more competition in the mortgage business, and you've got less confidence in levers to pull in deposits. I fail to understand why you think there's such good momentum outside of BOQ Specialist and outside of the fall in the loan losses.
Yeah.
The part of the technical answer to that argument is your growth in your net interest income is obviously a combination of your margin and the growth in your average balance sheet. In the FY15 year, we will have a headwind that the business grew virtually nothing in the 14 year, and so that natural average balance sheet momentum is not helping on the revenue side. Given the growth trajectory is improving, that is going to start to come through over the future periods.
Yeah, and look, I'll draw your attention to the fact that in our business bank we've actually grown at 1.2 times system. And sure, look, if you just strip out and you just looked at BOQ X the brokers, we're at about 0.5. That's coming from a standing start. Some of the things that we're seeing is that our settlements are up in our owner-manager branches. And I think it's an industry-wide trend at the moment as well, that there's probably not a great deal of growth coming out of branches for financial service institutions. But what you are seeing is this increasing growth by consumers to use brokers. So, again, we remain confident around that guidance.
Okay, thank you.
Next question is from Ed Henning from CLSA. Please go ahead.
Hi guys, Anthony, just a quick question from you, and you touched on it before, just on the BOQ Specialist business and the really kind of high cost to income ratio there. Is there much fat in the cost there that you guys can carve out there?
Look, that business has obviously performed really well. We're really comfortable with its momentum, and it's one of those things that you don't touch something that's not broken just for the sake of doing that. That business needs to continue on the path that it's been on. I'm sure over time there will be opportunities to explore ways in which we can collectively leverage the opportunities that the broader group provides to improve efficiency in that business, but it's not a high priority for us. It's driving that business in the way that it's been driven at the moment is the right outcome.
And I just want to add to that too is, when we flagged this acquisition this time last year, one of the key attractive elements to this was the fact that not only was it a great business and it's got great people in it and who are leading it, but BAQ Specialist was originating about $1 billion worth of mortgages through third parties. And we gave some guidance saying that we'd like to be able to get to at least 50% of that to on-balance sheet by year end, and we're clearly ahead of the curve there. And part of that increased cost that you've seen there on BAQ Specialist was to allow BAQ Specialist to put staff on to actually originate those mortgages. And again, we remain very confident about the earnings guidance we've given for that business as well.
Okay, just a second question on the commercial loan growth in just the BOQ business. Can you just talk about where that growth is coming from just you?
Yeah, look, we've been very, very deliberate about where we get our loan growth, and having had to rehabilitate a very large commercial book a few years ago, very attuned to ensuring that we actually are growing the right way. And what we've done through within our business bank is to be very targeted. We've targeted the rural lending. Now, we haven't seen a big increase in rural lending. We've largely stayed out of that during the drought, but very happy to say that the prospects there are improving with the recent rains. On the property finance side, what we do is support our customers that we've known for a long period of time, and we've got some customers that are finishing some developments that are now looking at some developments. We're very judicious around the settings that we have around that, and also in terms of the property development on the property development side, but also the property investment side. Some of the growth has come through relationships that the senior management team have known for a long period of time and are very attracted to the fact that BAQ can actually provide very quick turnaround times and to service their needs. So quite comfortable with the settings and quite comfortable that we're growing at 1.2 times system.
So, is there any industry, so there's a bit on the property side and some on the rural side, but is that, like if you look at actual industry?
Yeah, look, what we will be doing in the future is looking at specific industries. That's some work that we're currently thinking. We've got some very good capability around aged care, and again, we're not being all things to all people. It's not a shotgun approach that we're taking, and it's very much relationship driven, backed by strong risk fundamentals.
Okay, thanks.
Last question comes from Victor German from CBA Equities. Please go ahead.
Thank you very much. I was just hoping to also ask a couple of questions. One, or just a few questions on margin, and also one question on risk-weighted assets. With respect to margins, are you able to remind us about your hedging policies for balance sheet purposes? I noticed there's about 3 basis point reduction relating to lower interest rates. With further reductions that we've seen, can you maybe give us your views as to how that's likely to evolve in the upcoming period?
Sure. Look, we run a very conservative hedging approach to the entire portfolio. I think what you're alluding to is our capital and low-cost deposit portfolio. We have a replicating portfolio of derivatives which overset that element of our free funding, if you like. That is on a 2.5-year weighted average life. So it takes some time to come off. That just does reflect a drop in the yield curve. So that is reasonably market standard and a reasonably conservative approach to managing that element. The rest of the hedging activities are largely risk neutral.
And so we should expect a couple of basis points, a half drag from that continue to come through. Is that sort of the right way to think about it?
With the reduction in the yield curve that we're seeing at the moment, yes.
Yeah, okay. The second question on margin, I guess following up from, I think, Craig's question. With respect to your funding mix, are you still expecting to continue to build the long-term funding as proportion of your total funding, or roughly the mix should stay where it is?
I think we've done most of the heavy lifting in the diversification of our funding mix in the last half. So probably more close to maintaining the existing distribution.
Right. And lastly, just on risk-weighted assets, and thank you for providing additional disclosure on your mortgage book. If I look at the way the book is positioned, it sort of sounds like it's a pretty standard book. You've got weighted average LVR of 65%. Can you maybe give us a little bit of insight as to why your risk weighting relative to your exposure for mortgage book isn't sort of now mid-40s? Because if I look at high LVR lending bands, it doesn't seem like to be particularly high numbers across your portfolio.
Yeah, look, there's probably a technical answer to that question that's beyond this forum, but a significant contributor to that relates to the way we have conducted securitisation in the past, where there is shared collateral, and if you end up with a loan on your balance sheet, it ends up being 100% risk-weighted rather than 35% risk-weighted. That is legacy, and it's created some noise. We don't have the, if you like, necessity to rely upon the RMBS funding in the same way as we had historically. So expectation would be that will gradually reduce over time. Roll off, right? And are you surprised that it hasn't sort of rolled off quicker? Because and you also made comments that you're reducing your risk in the housing portfolio as well. Yet the risk-weighted assets seem to be gradually or stable or slightly rising, whichever way you look at it. Any sort of observations as to why we haven't sort of started to see this trending down? It's a question I'd have to take on notice and come back to you in more detail. Thank you. Yep.
Okay, we might take final questions from the floor. Brian.
John, I had a few questions. The first one is that when you have a look at slide 18, the IT, the capitalised software, the first thing that has to be stated is banks historically aren't very good at basically developing capitalised software. I'd just be interested, when you have a look at it, the assets under construction number is going up. I think you wrote off $10 million during the half year. Can you just, and I would have thought a new incoming CEO, that's the line you absolutely butcher. Can you just go through and make us feel that we shouldn't be worried about further impairments coming on that anywhere in there? And can you also reconcile for us how the CRM write-off that you did during the period, did it go in the blue or the yellow bit? Because if not, it implies that the assets under capitalised balance would have gone up the actual capitalised balance would have gone up a bucket load but for that. So we can get some clarity on the movement in that.
Yeah, certainly. Look, just at a high level, this is a bank for a long period of time that's not made significant investments, and we've had to make some investments to grow. We're very committed to unclogging the arteries of the bank. We're world class at moving paper. As I said, I'm the best customer of toll, I'm the best customer of snail mail still in Australia. What we have done is we are building, and we're not building, we've actually taken off-the-shelf software from a vendor to allow us to be able to take our mortgage applications online with the customer instead of filling out bits of paper. So we're not actually building it ourselves, we're actually adapting it, and we're well on the way to implementation, followed up by a digital process around settlement into the back office. So we're not actually constructing, and we've got teams and programmers running around doing anything. It's really focused on the software and adopting it to what it is without radically changing it in any way, shape or form. Comfortable with where we're at for the capitalised software. We went through a very rigorous process of reviewing all of those assets, and I'm comfortable with where we got to in terms of the write-off that we've announced on that particular asset. Anthony?
Your point's valid. The $8 million that we called out as the increase in the assets under construction would have been $10 million higher if not for that write-off. The growth in that line on the prior half was about $15-16 million. We're at full capacity at the moment. The lending program that we've got in place, the STAR HP transition program, are very substantive pieces of work, and we are continuing to. Those teams are driving pretty much at our capacity. So I think it's fair to say that we'd expect that type of spend over the coming period. What we're not seeing at the moment is as those larger investments that we've undertaken hit and start amortising, there isn't as much in the amortisation coming through at the present time.
Okay.
We talked about the balancing of the benefits from the HP contract transition and the sheltering that will provide us to some of that amortisation tail.
The second one, John, great effort on capital, and you're always going to cop a lot of stick about capital. It's interesting. I think a lot of the narrative that you hear from the regional banks seems to me that it's very much still based on the interim report of the FSI rather than the final report. But if we go back to the 22nd of December, when I think most sensible people were enjoying a beer, the Basel Committee actually came out with a paper that said standardised housing risk weightings probably need to go up. And it actually spoke about a grid which would actually see risk weightings basically more aligned to loan-to-income ratios and LVRs. And certainly when you have a look in Australia in a global context, I would have thought the risk weightings could actually go up quite markedly. Could we get some commentary from you on what happens if the reverse of what you've suggested is true, is that the actual risk weighting on housing moves up markedly for the regional banks, which is what that paper actually implied?
Well, Brian, I just want to reassure you that 22nd December, I was reading that report. And look,
it's two of us.
Look, the way we think about that, and look, that was a completely a different view to what we've all talked about from a regional bank perspective. And Anthony and I talk about this a lot, and I still think there's a lot of water to go under the bridge before they finalise that. But if that counter view was to prevail, I think what you have then is a rising tide for all banks in terms of capital. And look, that's a hypothetical at the moment. We need to keep a very close eye on how all this plays out, and then we'll respond to that accordingly.
Okay. I might add to that, John, if I can. I think it's important to put into context that there were two papers that Basel released at that point in time, and the first paper was we want to bring largely the undertone was we want to bring credibility to the advanced modelling system. Therefore, what we're going to do is come up with a framework for calibrating that to an enhanced standardised framework. So therefore, it moved to what's the standardised framework going to look like? Now, many jurisdictions around the globe for mortgages simply have a flat 35% standardised framework. APRA already has a tiered structure which is along the lines of what the Basel Committee are putting forward. As John said, there's a lot of water to go under the bridge as to exactly how the different bandings are likely to play out and those different tierings. Whether serviceability ends up being part of the final equation, again, is going to be certainly up for debate and still up for discussion amongst the Basel community, so it's very hard to know where that is. But I'll reiterate John's comment that our view is the rising tide of capital clearly is coming in. The question is, does it reach us? But we would suggest we're going to be the last and of the least impacted of the industry. And what it appears to be is an environment where particularly in relation to residential mortgages, the gap in risk weights is likely to significantly narrow, and we absolutely welcome an opportunity to compete on a much more level playing field than we have today. And we think that's going to go very well to our competitive position and our ability to return for shareholders.
I think the other thing too is that some jurisdictions have already moved, and some have increased their risk weightings, and others are still considering what the Basel implications are. So again, we will be strongly advocating for a much more level playing field. If you think about this, then the argument of you or I walking into any bank getting an 80% LVR home loan as a PAYG, and some banks have got 6% capital against it, or 10% or 12%, and us at 40%. It's got the same probability of default. It's got the same LGD. It just doesn't make rhyme or reason. So I think we're very strongly of the view that there has to be some sort of levelling of the playing field. But we're not going to walk away from the fact that we'll continue to look at the benefits of getting towards advanced accreditation and how that plays out with all of this debate around capital levels. And I still believe that there is a lot more water to flow under the bridge, and it is very hard to make a definitive statement about where all this will end.
Just a final related question. When you have a look at a lot of your rhetoric today is talking about the historic origination of home loans being bad, and turning on the broker channel seems to be a solution. And certainly you spoke a lot today about increasing the broker representation. I'd just be interested to understand the maths, because when you actually have a look at a broker-originated loan, it's the worst capital-intensive loan you can possibly manage. Can you actually make us feel a little bit more comfortable that the deduction of the upfront commission doesn't actually hurt that core equity capital generation even further?
So just at a high level, and I'll get Anthony to talk in some more detail about that. Obviously, the cost of origination of a broker loan is probably about the same as the cost of origination through an owner-manager when you talk in terms of the commissions that we pay to brokers or the commissions that we pay to our owner-managers. We're very careful about looking at that, and we're very careful at looking at what the return on equity is per channel, and we'll continue to monitor that.
Look, I think the point is that we are in an we have an owner-manager channel where we pay commissions under the same framework today, and it's not materially different moving into the broker space for us.
We might just take one last question from the floor.
Thanks. Brett Lemaitre, BBY. Just back on the loan margin, they declined 6 basis points in the half. Should we deduce from that the difference between the new business and the existing is of the order of 50 basis points?
I'd have to take that question on notice. Yep.
Okay, thanks everyone. We'll leave it there. Thanks very much for attending.